Hello everyone, and welcome to the latest stock market update. Let's dive into the key highlights as of January 10, 2024. The most recent macro data reveals a robust job market. The non-farm payroll monthly change indicates a job growth of 216,000, surpassing market consensus. The unemployment rate remains steady at 3.7%. However, observing the 3-month average, represented by the orange line in the chart, we notice a cooling trend in the job market. Job growth is broad across different industries, with 216,000 jobs gains predominantly from the private sector. Notably, the education and health services sector leads in job growth, showcasing a healthy labor market. In the job report, wage growth also delivers strong results. Wages rose by 0.4% in December compared to the previous month. On a yearly basis, wage growth stands at 4.1%, exceeding expectations and last month's figures. This marks the first pickup in wages in 6 months. Despite concerns about higher wage growth leading to inflation, recent statements by the Fed chairman indicate no clear evidence supporting this notion. This year marks a turning point as wage growth finally exceeds official inflation readings. After nearly 2 years of lagging behind inflation, this positive development brings relief to American families grappling with higher costs. With wage growth outpacing inflation, family real income may improve, spelling good news for the overall economy. The latest economic data also indicates a weak service index. Particularly, the employment component index shows a significant drop into contraction territory, reaching its lowest point since mid-2020. This survey data signals weakness in the service industry job market. Looking at the longer history of non-farm payroll and service employment index, using a 3-month average, we observe alignment over longer term. While the recent payroll data suggests job market normalization after the post-pandemic surge, with a 3-month average job growth around 160,000 per month, the latest service employment index reveals clear weakness. The coming months will determine if this deviation persists, with the market currently leaning towards a focus on payroll data. On the banking side, commercial and industry loans for all U.S. banks show negative yearly growth based on the latest data from the Federal Reserve. This trend, continuing after the SVB bank crisis, indicates potential weak economic growth. However, it's essential to note that weaker growth does not necessarily equate to a recession, as many indicators still signal overall growth. For the Federal Reserve, inflation remains a crucial mandate. The latest New York Fed 1-year inflation expectations shows a significant drop to 3%. Additionally, the chart on the right reveals a more than 25% drop in food prices from the peak, along with a decline in energy prices. Cooling inflation and inflation expectations is positive news for the stock market, as it may reduce the need for the Fed to implement overly tight monetary policies. Returning to the stock market, we are in a bull market with a strong rally in recent weeks. The pressing question is when we might transition to a bear market. According to the Citibank bear market checklist, we are not there yet. Only 7 indicators out of 18 have been triggered, covering valuations, sentiment, corporate behavior, profitability, and credit markets. This checklist has a strong track record, triggering sell signals before the 2000 tech bubble and the 2008 financial crisis. In 2000, 17 sell signals were triggered, while in 2007, 13 sell signals occurred. Presently, only 7 sell signals have been triggered, suggesting that it is still a buy-the-dip market. The S&P 500 index recently recorded a rare 9 consecutive weeks of rallying. Historically, strong momentum takes time to dissipate. Looking at the past 100 years, occurrences of the S&P 500 index rallying for 9 consecutive weeks happened only 13 times. Each time, the market was higher within 3 months. The drawdowns over the next 3 months were mostly shallow, with the worst drawdown in 1989 at 7.5%. caused by external shocks. In other cases, drawdowns were mostly below 5%. Assuming a 5% drawdown in the next 3 months, we could see the S&P 500 index reach 4530. However, with a 2 to 5% rally, the index could hit an all-time high, potentially surpassing 4850. In the short term, the S&P 500 index is supported at the 50-day moving average, which is currently at 4539. Interestingly, this aligns with the previously discussed supporting level at 4530. Lastly, this table illustrates that stocks have historically gained in pre-election and election years following a negative midterm year every time since 1950. After a negative midterm year in 2022, 2023, being a pre-election year, saw a 24.2% rally in the stock market. Looking ahead to 2024, which is an election year, historical patterns suggest the stock market will likely rally by at least 4.5%, potentially reaching as high as 20%. A reasonable expectation places the stock market's likely rally around 10 to 15% in 2024. This will push the S&P 500 index to 5,300. That concludes our stock market update for this week. Thank you, and feel free to share your thoughts or questions in the comments below.